get that going. All right, so let's get started. Today we're here to learn about business succession planning and insurance essentials. So starting with the agenda, to start off, we'll be introducing the role of estate planning in family business and how insurance can play an important part of that. And then we'll follow up with our two main topics that we're focusing on today. First off, trust in estate and succession planning. And then next off, insurance in estate and succession planning. First off, I'd like to introduce myself. I'm Jillian Wade. I'm on the portfolio management team at Yorkville, and as well, I'm Yorkville's CFO. For those of you who don't know Yorkville, Yorkville Asset Management is a boutique wealth management firm with clients across Canada. And our focus is managing money for high net worth individuals, families, as well as foundations and institutions. Next, I'm going to introduce Sandrine, who's here with us today. So Sandrine, who is an insurance specialist at YAM Financial Solutions, which is Yorkville's insurance arm of the business. And Sandrine, I'll let you introduce yourself. And you're on mute, just so you know.
Thank you so much, Jillian, for your introduction. Hi, everyone. Thank you for joining us today. My name is Sandrine, and I have the pleasure of speaking today about insurance. I'm an insurance broker representing YAM Financial Solutions. I have 5 years of top 1 insurance advisor at Manulife, where I won 2 Emerald Award. In the last year, I've had the opportunity to win the People's Choice Award and to be part of Yorkville. I work with individual, family offices, corporations to ensure they have adequate insurance coverage. This includes helping clients implement estate planning, generational wealth, other tax saving strategies, and fortify their business with insurance.
Thank you, Sandrine. And next, I would like to introduce Blair, who's at Botsford Law. And Blair, I'm going to pass it to you to go through your extensive experience in this area.
Thanks, Jillian, and thanks to Sandrine, and thanks to Yorkville for giving me this opportunity to speak today. So I'm a lawyer. I've been practicing for over 25 years. Actually, it's getting closer to 30 years. I can hardly believe where the time has gone. I run my own boutique will, trust, and estates firm right now, and I focus on pretty much all aspects of estate planning and administration, but I leave it to people with thicker skin than me to do the estate litigation. It takes a special personality for that. My clients range from working with individuals, high net worth individuals, individuals with disability planning needs, as well as working with business owners. I also sometimes work advising institutions such as financial institutions or charities. I belong to a variety of different professional organizations, and one in particular I'm quite fond of is the Society of Trust and Estates Practitioners. It's a global organization dedicated to excellence in trust and estates and provides great ongoing professional education. Yeah, that's sort of me in a nutshell. And
Great.
yeah,
Great,
trust.
thanks, Blair. And in case you didn't know enough about trust, she's actually doing her master's in trust law right now.
Yeah, thank you.
All right, so over the next couple of months, we're going to be having Sandrine and Blair host 4 webinars on business succession planning and insurance essentials. So Blair, I'm going to have you go through what you're talking about over the next 4 webinars at a high level.
Yeah, thanks, Jillian. So yeah, we broke it down. There's a lot to cover in estate planning, business succession planning. So we broke it down into kind of 4 categories. Today's the one about trust and how they relate to estate planning and business succession planning. In another segment, we'll look at shareholder agreements and their importance in business and business succession planning. And then there'll be a session on immediate financing arrangements, and I'll look at some of the unique legal aspects of that. And then just to kind of put a bow on it, connecting how estate planning and business succession planning work together to reinforce each other.
Great, thank you, Blair. And so Sandrine, could you take us through how you're going to complement Blair's topics with insurance strategies over the next 4 webinars.
Thank you, Jillian and Blair. So here's an introduction of the role of insurance in estate planning that we will be exploring over the next couple of webinars. Today, we'll be focusing on using insurance and the growth of life insurance. On the next session, we will explore the use of shareholders agreement using insurance as an example of buy-sell agreement, including keyman. We will also be diving on the topic of IFA as a unique insurance strategy. We will also be reviewing different insurance types and strategies to preserve and drive both business and estate planning.
Perfect, thank you. So with that, let's get started on today's topic. Blair is going to start off and she's going to talk about trust in estate planning and then trust in business succession. And then Sandrine will be taking over and she's going to go through insurance strategies used in asset protection and then insurance strategies used in tax minimalization. If you guys have any questions as we go through this presentation, please type them in the chat and we'll do our best to answer them all at the end. So Blair, with that, I'm going to pass it off to you.
Great, thanks, Jillian. So just to give a little bit of context before I dive into my absolute favorite topic, trust. So just, clarifying what is estate planning. Some people tend to think it only applies to a certain category of people. It's only for the really super rich, but really it's a little more mundane than that. Estate planning is a process. It applies to everybody, and it involves looking at what assets people have, what liabilities they have, what other legal obligations they have. So looking at the must-dos in terms of what's required to have your affairs in order while alive, and definitely when you pass away. But then there is some latitude, assuming there are excess funds, then there's latitude for people to be able to dispose of their assets as they wish. So you get kind of this matrix of what you have to do and what you can do. And part of carrying out your plans, there are legal tools to help carry out the plans. And the one, of course, near and dear to my heart, of course, is trust. They're a really flexible tool that have been around for definitely longer than me. They've been around about 700 years. So they've been part of the fabric of legal tools for a really long time. And kind of three main goals or focuses of what trust can do to help people are provide a mechanism for asset protection, also for asset management, and then also they can have a tax minimization role. That's not as significant a role as it used to be. Our income tax rules are not as porous as they used to be many years ago, but that's a whole complicated topic unto itself. So today I'm going to talk about more on the asset protection and management side. And when we're looking at protection and management, there are various issues that trust can cover in the estate planning realm. And sometimes it's very pragmatic. And it's not unusual for there to be beneficiaries of a trust, in particular as part of an estate, where there's simply potentially going to be under the age of majority, which is 18 in Ontario and it's 19 in some other Canadian provinces. So you're not going to give large sums of money to a 5-year-old. They couldn't give a release to the estate trustee. So without a trust to manage and protect those assets, they would either be paid into court, and then the parents would have to work with the public guardian and trustee's office or the office of the children's lawyer to requisition monies out. That's kind of a hassle. Or they could apply to court to be guardian of property for their children. Some people think that automatically they're the guardian of property for their minor children, which isn't the case. So just trust solve a practical problem. And then, of course, the division date, the distribution date can be farther out than the age of majority. And that's typically recommended to give beneficiaries a chance to achieve some financial literacy and maturity. So it's not unusual these days, given the size of estates, to see a distribution date of, say, age 30 or 35, and then incremental distributions along the way. above what the trustee is going to do directly. So a little bit at 21, some more at 25. And if people make a mistake, it's not fatal with small amounts. And hopefully along the way they get their feet under them. More and more we're seeing, blended families, more complex family situations, and trust can help achieve a balance. So there might be the first family and then the new family. It can, one person's kids, the other person's kids, the children together. So you had, stepchildren, what have you. So by using trust, it can preserve capital to cover off certain legal obligations that might exist, and smooth out who gets what when, rather than just having assets go directly to a person and nudge, nudge, wink, wink, trust them that they'll pass the amounts along to the right people down the road. And we wish that would work out, but given how many lawyers there are in the world, we know people don't always do exactly what we think they're going to do or assume they're going to do. And then in terms of disability planning, trust can be quite useful, again, for practical purposes, because people may lack capacity to manage assets, but also various provinces such as Ontario have government programs that can provide a stipend. It's the ODSP, Ontario Disability Support Program in Ontario, and that also comes with medical benefits. So by using certain forms of trust, people can protect getting those government benefits as well. And some people, really need a combination of things. And then in terms of more on the asset management side, I find as clients get older, they want to simplify their asset management. Powers of attorney are great. Everybody needs powers of attorney, but they're for simpler things like getting bills paid, taxes filed, what have you, but they don't have the same legal standing as a trust. And in terms of dealing with third parties like financial institutions, there's a greater comfort level dealing with trust. So it's nice to be able to consolidate house, cottage, non-registered monies, what have you, under a trust umbrella. And here I'm talking about alter ego or joint partner trusts. And of course, it also simplifies estate administration because you don't need to probate a trust. So it can get assets distributed faster in the GTA. The time to get probate out of the estates courts, it can be 4, 5, 6 months or so. That ties up selling real estate. It's a hassle. So trusts are useful there. And then if you're bypassing probate, you're also bypassing the probate fee or estate administration tax, which is, 15,000 per million of value. And then, of course, if there are other complexities like cross-border or multi-jurisdictional planning, sometimes trusts also have a role there to help address certain specific issues. So in a nutshell, that's kind of where trusts fit in estate planning.
Okay, perfect. Just a little bit of information there.
Just a little bit.
All right. So on to your next slide, trust in business succession.
Okay, thanks, Jillian. So, trusts also have a role in the business succession planning process. And again, it's the same three kind of top level goals of asset protection, asset management, and there can be tax elements as well. On the protection side, especially, when you have a private company, I find most founders, they're not really keen about the idea that their hard-earned efforts could be exposed to family law claims that would destabilize the business, or, other types of creditor claims. So properly structured trust can help shelter against that. I'm going to provide a small caveat and say that the family courts in Canada have an interesting perspective on trust. And even though people might only be, discretionary beneficiaries, they don't have a direct property interest in shareholdings that they could compel someone to transfer it to them. The family courts are trying to balance interests. So sometimes they'll still subscribe a notional value to that expectancy, and that creates some interesting challenges. But yeah, so trusts are great from the asset protection side, and then the asset management side by using what's typically an inter vivos discretionary family trust when the business is set up, or more likely when there's a reorganization of shares for tax purposes. The future growth is held in the family trust. Part of the goal is to multiply the lifetime capital gains exemption across more people, get more bang for the buck. But then you've got the trust managing the shareholding until it's time, and there's an appropriate time to make a distribution, which, a lot of times is just as the 21-year deemed disposition is coming up. And we're starting to see the use of voting trusts as well, splitting votes from value. So you've got the nominal voting shares, or what's sometimes called skinny voting shares, and then you've got the value shares. That's useful too. Partly it simplifies structuring a shareholders agreement, but you can keep the voting control with certain people. Using the trust can isolate against accidental changes in control that trigger stub year end, or convert the trust into a non-resident trust because you've got the wrong people in charge of voting control. So yeah, so you can have fun with trust in the business environment as well to achieve goals for business owners.
Perfect. Thank you, Blair. That's actually very helpful and brought up some good points that makes me consider I need to start planning for my family. So, and with that, I'm going to pass it off to Sandrine, and she's going to speak about protecting assets through insurance.
Thank you, Jillian, and thank you, Blair. Insurance is crucial when it comes to asset protection. There are two key areas where life insurance can benefit wealthy individuals. One of them is human capital, which consists of protecting the value of future earned income in the event of a premature death. On one side, it would be the replacement of a material value of a person for their family. So one's family can take mental and emotional breaks to recover from the loss of a loved one. On the other side, there would be a replacement of a key person for a business, so the business can continue normal operation after the loss of very important skill sets. The second key area is finance capital. As an alternative to investments, universal life or whole life are a safe option to grow your net worth tax-free while protecting it. Your net worth increases from day one. Universal and whole life have investment and life component where the growth of your life insurance is based on the market, like investment, but you still have the death guarantee. So you are guaranteed to get a minimum return in the event of a market downturn. Let's take an example. Let's say you buy whole life insurance. Whole life is equivalent to fixed income compared to investments. Let's say an individual buys 500,000 of whole life insurance, you'd be paying off the life insurance over the entire year of the insurance. The benefits are that you have a 500,000 guarantee starting from day one. You also do have the option of taking a loan against your cash surrender value. And in most times, because the life insurance is based on a dividend scale, it can be more than how much you have paid into it. The growth of the insurance can be up to 2 or 3 times. So on a 500,000 coverage, you can expect a return of $1 million or over in the later years of the policy. Insurance is a fantastic opportunity. It preserves a certain affluent lifestyle. Based on the amount that we determine, your family will be able to preserve or improve a certain lifestyle. Imagine instead of having to double the work while grieving, you can take time off, travel, have all your debts and bills paid off. Another reason why insurance is a great opportunity is it is here to protect and enhance financial capital, making sure your family will not need to liquidate asset to access capital. It's an easy access to liquidity upon death, making sure that your real estate is protected, making sure your main source of income of revenue is easily replaceable. That's why insurance is really an asset worth considering for your business and for your family.
Perfect. Thank you, Sandrine. And then I guess moving on to your next slide is around tax minimalization and insurance.
Perfect, thank you. So insurance is overlooked when it comes to tax minimization. Insurance is key in the process of organizing a tax-efficient transfer of your asset to specific people or charities. Without proper insurance and planning, tax can consume a significant chunk of your estate capital. For life insurance is a tax-free payment upon death used to pay taxes and fees so the estate does not get eroded. What's important to know about tax and insurance? We can work with you to calculate the amount of tax needed to be paid out at death, and insurance will cover it so your family will not have the burden to do that. You can also choose to have a beneficiary as a charity instead of letting your estate erode in taxes. Having a beneficiary protects your business and family from creditors. Insurance and estate planning ensures minimizing taxes so that beneficiaries receive a larger share. With insurance, you can be sure that the tax is paid out so that your family and your business successor receive a bigger share. Insurance is also a great option when having to give different shares to family members or shareholders in a business. It's an easy way to equally divide your estate. Let's take two different examples. You have a family business where there's a business owner and he has kids. One kid will be taking over the business, equal, let's say, $5 million. How will you be compensating the other kid? By getting a life insurance for another 5 million, you make sure that your estate is equally divided without having to worry about liquidity in the event of an unexpected death. If we take the example of shareholders, if you have a business with multiple shareholders, you want to make sure that you can use a life insurance to have liquidity to buy out the family of the shareholders not involved in the business in the event of an unexpected death. We will talk more about this on our shareholders series. Insurance also ensures that your estate has sufficient funds to pay taxes and other liability that will arise on death. It is important to remember that your net worth is different than your ability to have liquidity. If you don't have sufficient funds to pay off liabilities or taxes at an unexpected death, your business or family will need to liquidate your asset to be able to pay that off. That's why insurance is the solution.
Perfect. Thank you, Sandrine. With that, we're wrapping up. I'm not too sure if anyone has any questions or not. I don't see any in the chat, but if that's the case, I actually have a few questions for you, if that's okay. So my first question is for Blair, and you talked about this 21-year deemed disposition that applies to certain trusts, but what can be done to plan for this?
Yeah, thanks, Jillian. So yeah, that's a sort of an unfortunate rule that crept into the Income Tax Act a number of years back, and it does apply to a lot of trusts. The typical ones, an exception would be, say, like alter ego and joint partner trust, spousal trust, or certain ones where you don't get the disposition until there's a death. But yeah, the 21-year rule, what a lot of people end up doing is they anticipate it. So in the business scenario, they look at, transferring shares out just ahead of the 21-year rule. And then it goes out to, if the beneficiaries qualify, so say people are resident in Canada, they go out at cost base, so they're then held by the next generation, and then only when they dispose of them do you get hit with the tax. So that's sort of the number one plan. In terms of restructuring inside the trust to try and mitigate the tax, that I like to leave to my accounting friends and tax lawyer friends. But yeah, the number one strategy is just accept that there is this rule you're facing, and prepare to either have liquidity or make a distribution.
Okay, perfect. That makes sense. And is it possible for a trust to own insurance or for proceeds of an insurance to be held in a trust?
Yeah. So that's a great question. So you do have those two options. A trust can own insurance. So, aside from property related insurance, but they can own life insurance as well. And then the proceeds on death of whatever, the relevant life is, it's going to pay to the trustees of the trust and be administered as part of it. And then the related issue is that where you don't necessarily want the trust holding it, and say if you're trying to have a testamentary trust, there's a way to structure it that you specify who are the beneficiaries of the policy. But rather than it paying directly to them, you also name a trustee. So there's a provision in the Insurance Act to allow a trustee to be named. They'd receive the proceeds, and then you have the terms of the trust. But that trust doesn't arise until there's, a death, the life insured passes away. The owning insurance in a trust would be in an actual inter vivos trust as opposed to testamentary. So yeah, you can do both.
Okay, makes sense. And then Sandrine, a couple for you. You talked about estate planning and insurance. When is the best time to start considering this?
I do get this question a lot. Today, the earlier you think about insurance and estate planning, the better. Life is unexpected. For insurance, insurability gets harder with time and premiums do become more expensive with age. So the earlier you start thinking, the better it is for everyone.
So we should talk after this call. And then you went through some insurance strategies today, and I'm sure most people are familiar with term insurance. But you mentioned whole life too. So what's the difference between term and whole life, and in what situation would you use them?
Great question. So term life is for short-term protection, such as mortgages, debts, short-term business protection until the business grows. Permanent life is to create generational wealth and long-term protection. So it would be for the entire life of the individual.
Okay, that makes sense. All right, with that, we just wanted to thank everyone for joining us. If you do have any questions, I put up Sandrine and Blair's contact information on the screen. So feel free to reach out to them directly, and we hope to see you guys for our part 2 in a couple weeks. Thanks, guys. Have a great day.